Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, December 14th, 4:53 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're still in a rally attempt, pretty weak rally attempt, as we've seen selling in the indexes over the last couple of days. You can see over here on the trend gauge, market leaders were upgraded to neutral on 12/7, never got to bullish, but had some attempts. But people that follow us know that we had to completely undo the 21 over 21 2 weeks ago, rebuilt it last Friday. And there are some pretty decent stocks in there, good enough for it to be at neutral. Old leaders absolutely broken. If you hold on to old leaders, you're seeing 25 to 35% drawdowns off the highs in stocks like CrowdStrike, Net, Zscaler, and as part of the lessons learned from the stealth bear market in growth stocks back in February, one of the things that we took away was don't hold on to something just because of the name, and PayPal was the poster child for that. PayPal went from all-time highs and it dropped 28% in 3 weeks. We had a decent sized position in that, and you find yourself saying PayPal is one of the best of the best. Why would we sell that while it breaks the 8, then the 21, then the 50-day moving average? And it was very extended to the upside, and part of our lessons learned again is being prudent and not riding good gains down further. But the problem is we're taking more than our share of small losses, and that's indicative of what's actually going on with the type of stocks that we traffic in. And for that reason, when the market's like this, we are focusing on more index ETFs, letting the rotation within the S&P 500 guide the portfolio, and waiting for a better pitch down the middle of the plate for growth stocks, which we're not getting now, but we're always a couple days away from that should we get a follow-through day and some stocks breaking out of bases, which we're always on the lookout for. But for now, leaders neutral. Now, short term, big bifurcation has been for a while between small caps, mid caps, and large cap indexes. First close below the 21 today for the S&P 500, the Nasdaq 100. So one more close below there, and the short-term trend will go, which just went from neutral to up on 1210, will go back to neutral. We're going to really waiting to see the reaction to the Fed policy announcement tomorrow afternoon, and we'll go from there. 50-day moving average, same situation, not quite as bad as a 21 as we bounced at the 50-day. The Nasdaq 100 undercut the 21, bounced at the 50. The S&P didn't quite get there. The Dow still above it. Mid and small caps are below it, thus the yellow arrow. Long term below there, only small caps, so the yellow arrow there. But as we're above the moving averages on the indexes, the arrows stay green. But we're very well aware that from a leading stock perspective, this is not a healthy market right now, which again is why we're focused on indexes. So what happened today? Week again, another gap down, more COVID restrictions going in a lot of parts of the world, not to mention the US. So week again broke below the 21 on the Nasdaq 100 and the S&P 500, and waiting on the Fed tomorrow, as I mentioned. Growth stocks, the G5. This has been a big key in protecting we had a 13% rally off of the low in early October, and we've kept a little less than half of that now. But if we would have not implemented the rules that we did from early February, we'd have given back quite a bit more. And one of those is this monitoring of the G5 index, which is used as a verification that when we're seeing some of our holdings weak, that it's not just what we're holding, it's the broad trend. And this continues to underperform. G5 minus 1.4% on the day. S&P 500 gap down 0.8%. Very brief rally the first half hour, rolled over again to new lows, then a little bit of a weak rally in the afternoon, but that gave it up again the last 30 minutes, so down 0.75%. Nasdaq 100, again, the weakest index, was down over 2% at one point, trimmed that to down 1%. Dow, the strongest of the five, down 0.3%. Mid-caps down 0.5%. Russell 2000 down 1%. Was green at one point in the day, but oils rolled over. They went from green to red and took the Russell with it. Strength in banks helped cushion that move down a little bit. So let's get to the market facts and the key levels. But first, let's take a look at the gang here at Revere, striving to participate in uptrends, protect capital in consolidations or downtrends. And if you're interested in talking to us about an approach like this, does not sync with what's going on with the market all the time. There are, I did a last week's webinar, I talked about crisis alpha that we will get. Crisis alpha being how we'll far outperform during severe market corrections or bear trends. And like in the last half of 2021, we can very much outperform during strong bull trends. In the middle, we pick and choose what we're going to be invested in, and there's times that we'll have mild underperformance and times that we'll have moderate underperformance. There's times that we'll have mild outperformance depending on what the market is doing and also depending on what growth stocks are doing. We know we've had issues back in early February with the stealth bear market and growth stocks, and we continue to fight the battle every day of what's going on with the market while protecting our accounts from major downside sell-off. So if you're interested in an approach like this, reach out to any of us. You can email Dan, Tim, Hunter, Muriel, Alex, or Don at revereasset.com or phone 855-REAL-WEALTH. That's 855-732-5932. So let's get to the charts now. We're going to start off with the S&P 500, and I'm going to bring in the market facts and the key levels here. So rally attempt on 12.6. So this is the first day off the low, 12.6 here. We got back above the 50-day, could not get back above the 21. The real rally, where we got hope for a ride to the upside, really was in 12.7 with the gap up, and then we made two higher highs after that. But today, a big expectation breaker for this as we gapped below the 21 day. But we did finish off the lows right below the 21, which has now rolled over. Market really waiting for to see the Fed reaction now. Is it going to be more hawkish or dovish than the market is expecting, and what will the reaction to be? What will the reaction be to it? That's what we will be keeping our eye on. But for now, the bull case, stay above the 21 and the 50-day moving average. We're stuck between them right now. We'll see what tomorrow brings from that perspective. What I was on watch for this week was a follow through to Friday's strong close. We very clearly have not gotten that with the action over the past 2 days. Hopeful over the Sunday night with the futures, we were up, but then by the time we opened on Monday, we were mildly down, and that morphed into a sell-off, and then that morphed into a gap down this morning. So definitely no follow through to the strength that was exhibited last Tuesday, Wednesday, and Friday in the market. So pretty much most of that gap up undone. Let's see what happens tomorrow and what the reaction is. But before the market opened, we had PPI came out, and it was the highest annualized inflation on record since they started measuring this. And this signals continued inflation because if producer prices are going up, consumer prices are going to be going up because the end manufacturer or company selling goods and services has to pass this on to their consumers or take a financial loss. So continued inflation, that's really what was responsible for the gap down today. Gap down, failed bounce to a new low, and then a weak afternoon bounce before a sell-off. As I mentioned, G5 weaker than the S&P indexes. We did some more stops got hit today. QLD with the gap below the 21-day. EMA closed that out. Also Roblox and AMBA breaking their 21. We also trimmed some QCOM and a little bit of Apple. Big gains for a lot of clients in Apple, as this was one of the first entries that we made into one of the first buys that we made after the follow-through day for COVID back in April of 2020. So trimming a little bit of those oversized gains in Apple. Sectors that were strong today: banks, steel, base metals, and you never want to see strength in staples because normally that means that growth is lagging, and that is again what we saw today. Oil's reverse negative, solars, software, tech, home builders, and biotech all weak today. So key levels, we're at 46.34. Again, trap between the 21-day moving average and the 50-day moving average. The prior all-time high, this 4,700 to 47.15 level, which we tried to pierce a couple of weeks ago and then tried again last week. That's failed again, so that's severe resistance. A real bull move would be a breakout above that level. But the market, certainly from a breadth standpoint, is not showing any willingness to do that right now. Mid-November support at 46.52 failed today. You can see this pretty clearly. 46.52 here, got back above it last week, below it today, rallied up and reversed at 46.50 today, so we couldn't get back above that. So that's a case of support flipping to resistance, got back above it and failed it again. So that 46.52, a kind of critical level that we failed today, along with the rising 21-day exponential moving average. We do remain above the 50-day, and both on the Nasdaq 100 and the S&P. The 200-day moving average is 6.9% down, but it is now above this 42.78 level, the prior low of the prior correction. So that should provide a good area of support should we get down that far. Let's go to the Nasdaq 100 right now. Very similar setup, a little bit worse today as we undercut but then reclaim the 50-day moving average, but a clear break below the 21. This gave us some hope with some, but the market was really being held up by the big FANG type stocks, and anytime a little bit of selling came in on those, that really picked up a little bit today as Microsoft failed to 21, down 3%. Tesla failed, has not been able to get back above the 21. Let's take a look at those charts. Here's Tesla. When the 21 rolls over and you can't get back above it, this is a big, major flashing red flag. I don't know if flags can flash, but they can wave. But it's like my number one sell signal on a bounce back up. If you can't get back above the declining 21, that's where we sit right now on the S&P 500. So it just barely rolled over. If we come down and bounce off the 50 and then fail back into that, that will be certainly a problem. Same thing that we're watching on the Nasdaq 100 now. Saved, 50-day moving average saved. So you've got that support here. You've also got support in this area here from a week and a half ago, and you've got this 382.78 also providing support. So multiple support levels there on the Nasdaq 100. But we need some more stocks to come in and participate, as former leaders have been absolutely bludgeoned. 45, as I said, 50-day moving average was broken twice, reclaimed, and it did hold again today. So that's something we're definitely going to be keeping an eye on. Now, the strongest of the index is Dow Jones Industrial Average here. You can see it by the relative strength, which followed this multi-week relative weakness as the big Nasdaq 100 stocks outperformed. But pulled back today, bounced off the 50 and the 21 day, which are pretty much gathered up right there. Let's go to the Dow Jones average instead of the DIA, and it's that 35,470 area where we bounced today. So that's a key level going forward, and actually a very low risk entry point if it holds. Mid caps, MDY, weaker than the bigger indexes, but certainly better than large caps. But you can see the lack of relative strength here, this big H pattern being made. In fact, relative new lows in the relative strength before price, that's a big minus for any stock, any sector, any index. Certainly fits the bill with mid caps and small caps relative strength in a free fall here. And in fact, we're probing the lows of 2 weeks ago. A lot of support. It's somewhat firm. You can see as this area between 210 and 215 has been tested multiple times going all the way back to March of this year. So we are coming into a big support area here. A lot of times the bears load over to one side of the boat, and then if Powell doesn't negatively surprise anybody tomorrow, I would not be surprised at all to see a snapback rally in small caps and growth stocks. Let's take a look at the ones that we keep an eye on that make up the G5 index. First of all, IWO, you can see this bouncing off this 280 area, which again has been major support going all the way back to March. And then you've got FFTY. This is the IBD index, which made new lows today. Again, coming into a support area back to March. You've got PDP, which is a momentum ETF, sitting on the 200-day moving average. This is actually the strongest of the growth indexes that we track. But again, look at the lack of relative strength over the last 6 weeks, which has been apparent in all of the G5 indexes. QQQJ first, we want to show. Again, lack of relative strength over the last few weeks, but again, coming into a support area, this 30 to 32 area, going all the way back to March. And then the former darling now in the dungeon has broken the March lows and the May lows. ARK-K, again, very oversold. Let's turn stochastics on quickly here so you can see how oversold this is, as long as I click the right buttons here. Okay, it's because I enlarged the chart. Okay, stochastics, you can see how oversold this is. Tried for a weak bounce and then rolled over again. Big ugly H pattern there. So those are the key indexes and the key stocks. And let's talk about some possibilities that we can look at. One of the things we're also going to be looking at is some big names around the 200-day moving average, some quality companies. We call them titans off the 200. That's one of the, if the market gets a follow-through day and rights itself, some of these former leaders off the 200-day will be something that we'll keep a look at. But always remember, from corrections come opportunities. Keep your watch list updated. Let's look at what we're still holding on to. I did mention that we trimmed some Qualcomm today, but this is one of the better looking charts that you'll see here, still firmly above the 21-day exponential moving average. ANET, also still own this, great looking chart. One thing they have in common is an earnings gap up that hasn't failed. And a cousin stock to this we don't own, but Juniper, JNPR, even a little bit stronger than ANET. And of course, we're still holding some Apple. That got really extended up to the +3 ATR today, pulled back and bounced off of the ADMA. Some things that we sold last week that are now I heard that are now lower than where we sold them. I did see a bull market kind of described tongue-in-cheek, but it's actually accurate that a bull market is when you have to buy some stocks that you sold, buy them back higher than where you sold them. That's always something that we keep an eye on here. One of the things that we got out of, got back in, and then recently got stopped out of, our initial stop on AMBA was with this gap up day where it had the hard reversal. Got out of that at 212. AMBA's down at 195 right now. Roblox, we initially sold at 119. Bought it back. It's back at 107 after getting stopped out on the break below the 21 today. Nvidia, we got out of this at 326, 305, and 296. Did bounce nicely. Again, low risk entry here off the 50-day moving average. We'll see if we can get some follow-through strength to Nvidia. The trade desk sold this at 102 and 99. It's at 88, but again, bounced off the 50-day moving average today. Tesla, we got out at 1105. That's down at 958. Again, there's that big sell signal when you couldn't get back above the declining 21-day exponential moving average, and it's pulled back now to the low of the gap up day, and it bounced at that area today. Net, We got out of this at 174, down at 132, approaching the 200-day moving average. A lot of support in this area here on net, this 127 to 137 area where it's sitting now. But this is one of the leaders that if it bounces at the 200-day moving average, if you're so inclined, if the selling is over, I would expect fund managers to come in and support that off the 200-day moving average. At that point, it'll be about 45% off of its peak at 221.64. One that we did get out of that is now higher is new, as steel stocks did have a good day today. Not really inclined to try to chase this, but steels are acting well, and when they move and they move in a group, they can move pretty quickly and with some strength. So that's going to wrap it. As always, like to hear some feedback from you. I'm on Twitter at D Vandenbord. You can email don@reveraasset.com or phone 855-REAL-WEALTH. Looking ahead to the Fed announcement and, more importantly, the reaction to that announcement. We're in a pretty oversold territory here. Leaders are dwindling. Some things have been absolutely bludgeoned. We are kind of set up for a bounce. We'll see if that bounce can work its way into a follow-through day with some nice bases and some sound stocks breaking out. That's always what we're on the lookout for. From corrections come opportunities. So cutting losses short, short-term underperformance can very clearly be rewarded with longer-term outperformance when you get the winners and you ride them higher. So that's going to wrap it. Finishing up Tuesday, December 14th. This is Don Vandenbord with Just the Facts. Thanks for listening. Have a great day.